The latest CPI report was just released. Let's talk about it. Thanks for joining me today, guys. We're going to take a quick look at the CPI report that just came out. The Consumer Price Index, which is a key inflation gauge, rose 3.5% from a year ago in March, which is a little bit higher than expected, and it marks an acceleration for inflation here. So for those that are maybe coming to MarketBeat to view this information for the first time, let's give them a quick overview of the report. Thomas, why don't you start it out for us? What sector saw this most significant change here, and what are the driving factors with this?
Well, right. I first just want to point out that this data was hot across the board. We're showing acceleration at the headline level, and the core was flat. It could easily accelerate over the next month or so. So this really was not a good report. But as far as the segments and sectors, it's really more about which ones didn't show a price increase. And that really was just automobiles, used cars, and RVs, because people can't afford them anyway. They're already too expensive. But shelter and gas was the biggest influence on prices. They accounted for 50% of the increase. And what's really significant about that is home prices will not go down because of demand, and gasoline prices underpin the cost of everything else. It is a compounding factor for the economy. With gas prices rising the way that they are and oil on the way up as it is right now, we can expect inflation to remain sticky and persistent for some time.
Yeah, and one of the big surprises that came out of the report, and it's funny that it was a surprise in the report because I don't think consumers see it as a surprise at all, is the dramatic increase in auto insurance premiums. I've been seeing that all over my social media feeds, and I can see it in my personal auto insurance bill. They've gone up significantly since last year, and that's that lag effect of inflation, even from last year, that's being felt now in insurance premiums. And I'm sure that you're also going to see that in home insurance premiums and probably medical insurance premiums going forward too. As Thomas said, the other part of this is it's a huge energy story, and energy just affects everything that people buy in the grocery store. They just don't think about it because it's the cost of transporting it, the cost of the packaging to make it. All of that is an energy story.
All right. The labor, the manufacturing, the transportation, you got to think if there's 4 or 5 levels of the economy from the producer to you, each level is going to pay a higher cost because of gas. And that cost is going to compound as it gets pushed through the economy until the consumer pays for it. And that's why right now we're looking at prices being up like 17, 18% on a 3-year basis. We're living in crazy times right now.
Okay, I do want to jump in here on one of the sectors that you had just mentioned, the automotive sector.
Yeah.
So given the resistance from consumers on vehicle prices, how do you kind of see this affecting the automotive industry and consumer purchasing trends in the near future then?
Well, the automotive consumer trends are definitely being affected. So car prices rose, and now car sales are flagging. They've been weak. They're not growing. Car prices have started to come down. That's being offset by the increase of insurance prices. So someone who's having a hard time with money and thinking, should I buy a new car? One, there's the increase of the new car cost. Plus, there's the increase of your insurance, because when you get a new car, your insurance is going to go up. So I think that the automobile industry will probably have a hard time over the next year or two. I don't think it's going to implode, but I would not expect any kind of significant growth.
Tired of guessing which stocks to ditch? MarketBeat's exclusive report, 20 Stocks to Sell Now, cuts through the noise. Uncover the truth behind Wall Street's ratings, as our list is curated from the stocks that top analysts consistently rate as hold or sell. Don't let your portfolio suffer. These 20 companies have been red flagged for a reason, so act now and safeguard your investments. This report is free, but only available for a limited time, so download today.
And I think another point there is that, excuse me, and this might not be as much of an inflation story, but I think it all ties together with the energy story, is you've got so many of the legacy car manufacturers right now that have shifted production to EVs, which already carry a premium on price that consumers are already saying they don't want to pay. So there's not as much supply going into the market of the internal combustion engine cars that consumers may be able to afford, but maybe now won't be able to afford because there just isn't, because the demand for them will be so high.
Right. And that's also why the OEMs are cutting back on EV plans, and they're shifting into hybrids because they need to try to stay green. They need to keep the cost low, and hybrid is the way to go.
Okay, so what, this is the third straight month that we've seen inflation that has been maybe a little bit too hot. With inflation continuing to surpass expectations, what are your guys' kind of projections for the CPI in the coming months? I mean, do you kind of see a continuation of these trends, or is there a potential for us to return to a downward trend in inflation?
The way the data looks to me right now is we are rebounding. Inflation is not, if it's not going to accelerate, it will at least persist at this high level. There's nothing to say that it won't. What we're really talking about here, though, now, and the risk for the market is the FOMC. Chris can comment on this too.
Yeah.
The market is expecting the FOMC, or has been expecting the FOMC, to start cutting rates in June or July. That will mark a significant economic shift and pivot, hopefully to reaccelerate some activity. But they don't need to reaccelerate activity if it's already causing such high inflation. So right now, the risk is that the FOMC will not cut rates over the summer, and they might not cut rates again at all this year. And that just means that the back half outlook for the S&P 500 and earnings growth is garbage. And that could cause a real big stock market correction.
Yeah, I mean, Lacey, I don't want to put our viewers to sleep, but I mean, the fundamental definition of inflation is too much money chasing after too few goods. And whether people want to say that's the definition of it or the cause of it, whatever. But I'm not optimistic that you're going to see CPI coming down in future quarters. And the reason why is because there's just simply a lot of government money going into the system. There's still a lot of stimulus coming in the form of, when you looked at the jobs report last April, or last month, excuse me, well, actually last Friday, if you want to get right down to it, still about a quarter of the jobs created were government jobs. That means that there's still a lot of government spending in the economy. You still have money from the ironically named Inflation Reduction Act,
right,
pumping into the economy, from the CHIPS Act pumping into the economy. And you can feel however you want to feel about those acts and whether or not that stimulus is necessary for those industries. I'm not here to debate that, but what I'm saying is you've got that money that's still pushing into the economy. That's an inflationary effect. Plus, we're finally starting to coalesce around this idea that the employment numbers we're seeing is being largely impacted by the fact that we've increased the legal or illegal population of this country dramatically over the last 3 years, and that's trickling into the employment data and making those figures very muddy.
right. We've talked about the government spending before. Without all this government stimulus, we probably would have been in a recession or a very uncertain economic time for the last 24 months. That's really the reality of the thing. Something I saw this week that we've also talked about before and that we brought up way back at the beginning of the rate hiking cycle is that higher interest rates are also helping inflation to persist because demand is still strong, the economy is still strong, but we have to pay more money to do what we're doing. Right. So that's inflation, right? Because of the cost of interest rates. So CPI coming down soon. I do not think it's going to hit the Fed's target of 2% soon or on their target timeline.
It may linger around this. I don't know if it goes significantly higher than this 3.5%, but I don't see it. I mean, forget about getting down to 2%. I'm not sure it gets down below 3% anytime soon.
Right.
All right. Do you guys have any additional thoughts that you would give to investors based on the current and projected economic environment right now?
Oddly, the S&P 500 may be able to continue rallying because the economy is still solid. We're still producing solid economic growth. The big negative is inflation. Right. So right now, the economy and the market is racing with the Fed towards this idea of interest rate cuts. In this situation, any signs of market weakness, economic weakness, means the Fed can step in and cut rates or do some other kind of stimulus to help reinvigorate the economy, which to me means the Fed put is in place, which should help keep the market rallying higher.
Yeah, I mean, I think if you're a long-term investor, I know it sounds boring and it probably isn't a lot of comfort for some of them if they're looking at the market today. But if you're long-term, and I'm talking, 5-10 years down the road, you stay the course. You do what you're doing. Stick with the high quality companies. You're going to come out of this just fine. For a trade, this is going to be a really, really choppy scenario for the next few months. I personally don't think if I were them, I would be counting on a rate cut. I kind of think the Fed's going to hold the line on rate cuts. I think they're going to be looking at some other things. Don and I were talking before the video. I think you're going to want to look at the Fed balance sheet and what they might be trying to do there as far as trying to take care of some of the government debt problems in other ways. But that's a topic for another video.
All right. Well, thank you guys for jumping on quick to cover this report with me. I always love hearing your guys' take on the latest market news, and I hope that our viewers do as well. Let us know in the comments down below what you make of this report. Otherwise, stay tuned because we'll be right back here at MarketBeat with more. We'll talk soon.